Hey, how you doing, everybody? It's Sid again here from the Sid Chase Group, Sid Chase Capital. Today I wanted to talk about the stock market, right? And putting away money for your future, or maybe your family's future, over the next 10 to 40 years, depending on what your time horizon is, right? Because I actually had a talk with a friend of mine yesterday, actually my son's father-in-law, and he thought he was too old to get started investing. And so I made some points to him that he's not too old, especially when he's 10 years younger than I am. Doesn't look it, but he's 10 years younger than I am. So I'm just kidding because he's right there in front of me. Anyways, so I'm going to do a little math. Hopefully I got it all right. And we're going to do a little live thing here. We got the computer screen over here going. And so we're going to add in some blanks as we're going along. But I just want to show you the power of interest and how it compounds, okay? And really how little you need to get started, right? And what the most important thing is time. Now look, you can either do this on your own and make it your retirement. I would not recommend that. That's not what I did, actually. My wife Julie has a self-directed IRA that she uses to invest into real estate and some stocks and gold and silver. I have a regular Roth IRA. I spent most of my life working for myself as self-employed or owning a business. I worked for UPS and I worked for the military, but never long enough really to, I was in the military for 15 years, but I was never there long enough to get any type of 401k or retirement plan or anything like that. So I started my own Roth IRA. But I also started what I call a dividend portfolio. Now, this is a longer term outlook. You're not trying to, get in and scalp stocks or anything like that. These are long term purchases. You're buying over time. You're reinvesting the dividends and things like that. But for me, it's Julie and I may use some of the income, 10 years from now to live off from a little bit. But it's really for the next generation. Right, it's for Julie and I have 5 boys, right, and 10 grandchildren. So really, that portfolio that we're building, right, is really for them, and then for them to hand it down to their children, right. And it doesn't matter what you do. I don't care where you work. I don't care what you do for your job. Okay, well, as long as it's not illegal, but you get what I'm saying. It doesn't matter. You don't need to be making $200,000 a year, or you can do it on $25,000 a year. You can do it on $20,000 a year. The point is, it's just the numbers are different, but the end outcome is still the same. It's not the same in the dollar amount, but the freedom's the same. Because when you're done, you're going to have freedom, just like I'll have my freedom. Right? And that's what we're all looking for. All right, so let's run through this. It's called the dividend portfolio. And what I did here is I took 3 stocks, and one of them does 14%, another one does 11%, and the last one does 8%. Okay? Now, you might think I'm crazy on a 14% dividend, but they're out there. Okay? GGN, for example, Anna Lee, there's a few of them out there that are paying high dividends. So they can be a little bit more riskier, but they are there. So again, this is just for me to show you. You don't have to pick out what I'm doing. You can pick out your own. Okay, so I picked out these 3 stocks, added them all up, gave me 33%, 33 total, divided that out by the 3, gives me an overall 11% yearly return. Okay, oops. Now, one of the things I did is I picked, specifically my wife and I picked out monthly paying dividend stocks monthly paying dividend stocks versus yearly or quarterly paying dividend stocks. I like to see the money coming in every month, number one. And number two, it's easier for me to watch what that stock or that company is doing every month versus every quarter or every year when they pay their dividend. Okay, so that's what I did. So I'm going to use this example of that I had $30,000 sitting around. Now I know a lot of you don't have that type of money, so it can be whatever number you want to put in there. And if you're real young and you don't have the money, it doesn't really matter. The point is you got to get started, okay? You just get started. But let's say that you got some type of windfall, right? Or you worked all summer long doing something for 2 years and you ended up saving up $30,000 and didn't know what to do with it. You couldn't decide whether you were going to go real estate or whatever, buy a house, whatever it is you want to do. Just remember, buying your own home is not an asset until it's not an asset until you sell it, right? And you receive the income from it. Okay. All right. So $30,000, $10,000 each one. Okay, so that's where my 30 went. All right, so 11% is my total from 3 for the whole year on my return. So in 10 years from now, I'm going to have, go ahead, $85,182.63 in 10 years without putting any more money into the fund. Now, there's going to be one little catch. I'll tell you at the end, but it's okay. Okay. And now, if you did this for 20 years, okay, it's $241,869.35. Good googa-mugga. Almost, what is that? Almost a quarter of a million? That's not too shabby. All right, let's see what 30 years is. Oh boy, 30 years. $686,768.90. 30 years, you have almost, not quite, but pretty darn close to $750,000. All right, so you got to know in 40 years we've got to be over $1 million, right? Almost. Almost $2 million, folks. Did you see that huge jump? Look at that huge jump. That 10 years. Look at that huge jump into each one of them. What 10 years does. That's the power of compound, right? And that's the power of interest, right? Okay, so what you are asking, some of you are pretty smart out there, I know you are. So you're saying, I already know what the catch is. All right, so here's what the catch is. This $30,000 is, we're going to call your principal. Okay? When you buy stocks, you might buy a stock for $4.62, one for $32, and one for $62. Okay? That was your $30,000 hypothetically, right? The problem could be a problem with this over the years is that these are obviously going to change. Now when they go up, it's all good, right? When they go down, not so good. But here could be a little risky 10-year period of time, but the markets usually rotate around every 10 years or so, 6 to 12 years. So, it could be a catch, or it could not be a catch. But once you start getting into this one, and this one, you're not worrying about these numbers changing so much because you're in for the long haul. You're buying good quality companies that have free cash flow, that are buying back their stocks, and that they've raised their dividend year after year after year after year. Those are the companies you want to look for to purchase, okay? And as you're purchasing these, okay, what you want to do is reinvest your dividends back into it, and that's what's going to build up your share count in here, right? So let's say on this one here, you're going to buy, let's say $10,000 divided by 462 is about not quite 3,000 shares, I think it is. It's not a direct number, and I don't have my calculator, but it's probably pretty close. So as you reinvest those dividends, what you're doing is you're buying more stock, right? So if this number moves, there'll be times when you're buying it a little higher, and there'll be times when you buy it a little lower, and it all balances each other out, especially the farther out that you go. Okay? I have a friend who bought GNG over 2 years ago. He bought it a little bit high, but then he kept buying it though on the way down. Now in my scenario, it's a one-time effect, okay? But I would suggest you continue to put money in every month if you can, even if it's $50, right? In each one of them, so $150 a month. He kept reinvesting his dividends, and he now has over 6,000 shares of GGN. GGN is the one that pays not quite 14, just about 14%. So it's 60 cents a year. Divide that out by 12, that's 5 cents. So it's a nickel a share. So he's got 6,000 shares, times that by 5. What do we got? $300, a little over $300 a month, and about $3,600 a year, $4,000 a year. And he's done that in less than 18 months. Pretty impressive. Just gotta put your blinders on, be focused, and go after it. Folks, it doesn't matter what the numbers are. Start wherever you are. Wherever you're at, just start saving. I wish I would have done it sooner. I'd be a lot farther ahead than I am now, right? I feel like I'm always trying to catch up. You can never catch up. If you miss a year, you've missed a year. Doesn't matter, right? It's as simple as that. If you miss a year on a Roth IRA or an IRA or whatever your portfolio is that you have, if you miss a year putting money into it, you just missed it. Even if the next year you make that, say $6,000 is what you put in every year, and the next year you put in $6,000 or you make $6,000 in it, you still got to double that money, right? You got to double it to get the $6,000 back, plus $6,000 plus all the interest you would have made off from that year. So, right, folks, just put the money away, okay? No more buying Nike shoes, no more buying all this extra stuff, no more, 3 latte caramel mocha hookah buchas or whatever the heck they're called, at $6 a pop or $4 a pop. I don't know. I just know my wife does that occasionally. Unless I'm driving, then I don't stop. But just put the money away. You got the money. You got $5, you got $10, you got $50 a month. You could go out and find $50 a month if you needed to. Just get started. All right, thanks, folks. I appreciate it. Check us out at sidchase.com, Sid Chase Group, Sid Chase Capital, all Facebook, Twitter, YouTube. We got a YouTube channel. Check us out there. Instagram. We're all over the place except for Snapchat. Take care. Enjoy. I appreciate your time. Thank you.